The world changed on February 28, 2026. Today, we analyze the Iran conflict and the massive opportunity hiding in the stock market dip. It started with precision strikes. Geopolitical tensions that had been simmering for years finally boiled over, sending shockwaves through every global exchange. At the heart of the crisis is the Strait of Hormuz, the world's most critical oil choke point, now caught in the crossfire. The reaction was instant. Oil didn't just rise, it exploded, crossing the $120 mark almost overnight. 21 million barrels of oil flow through this narrow passage every single day. Any disruption is a direct hit to the global energy heart. This isn't just an energy problem, it's an inflation engine threatening to derail the global economic recovery we've worked so hard for. Panic is the market's first language. The Dow and S&P 500 saw immediate sell-offs as investors fled to safe havens like gold. Gold reached historic highs as the fear trade took over. Investors are looking for stability when the world feels anything but chaos. But for the disciplined investor, this chaos creates a wartime discount on some of the world's strongest companies. History tells a consistent story. Markets dip on the unknown, but they rally the moment the outcome becomes clear. We've seen this in every major conflict. Let's look at our first recovery pick, United Airlines, currently trading at a heavy discount and has been falling 25% since the SDU to skyrocketing fuel costs. Airlines are being squeezed from both sides, expensive jet fuel, and restricted air routes over the Middle East. It's the perfect storm. But travel demand is resilient. The moment the conflict de-escalates, fuel prices will normalize, and this pent-up demand will drive a massive rally. Similarly, Delta Airlines is a prime candidate. They have one of the strongest balance sheets in the industry to weather this temporary storm. Delta's strategic fuel hedging and modern fleet mean they can pivot faster than competitors when the recovery begins. To hedge your portfolio during the peak of conflict, look at the defense contractors. Their orders are scaling as we speak. Companies like RTX or LMT are critical infrastructure for the modern battlefield, providing the stability and revenue growth that offsets broader market dips. Don't overlook the tech giants, Alphabet, Microsoft, Nvidia. While they seem unrelated, the general market dip drags down high-quality software companies like Salesforce that have zero exposure to the conflict. These are the companies powering our digital world. Their revenue streams remain intact, making this dip a pure valuation play for long-term holders. In 19 out of 20 major military interventions since the market recovered fully within a month. This is your window. The key is distinguishing between structural damage and temporary cost spikes. If the business model is still solid, the dip is a gift. Post-war recovery also means rebuilding. Energy infrastructure and construction sectors often see massive capital L injections once the fighting stops. Manufacturing and global supply chains will kick back into high gear, fueling a second wave of growth for those who stayed the course. The plan is simple. Stay calm, identify sectors hit by temporary costs, like airlines, and wait for the inevitable pivot. When the Strait of Hormuz reopens, the risk premium in oil will evaporate, immediately lifting the weight off the global economy. We often see a V-shaped recovery. The sharper the dip, the more explosive the bounce back once the geopolitical clouds part. A balanced portfolio during conflict keeps your emotions in check while positioning you for the massive gains in the recovery phase. As the legendary Warren Buffett said, be greedy when others are fearful. This conflict is scary, but for your portfolio, it's a generational opportunity. We invest for the decades, not the days. This conflict will eventually become a footnote in a long-term chart of growth. The headlines are scary, but history is on the side of the patient investor. Stay focused on the fundamentals. I'll see you at the recovery. To recap, watch the airlines for the bounce, use defense as your shield, and look for quality tech in the general market sell-off. Stay safe, stay informed, and always trade with a plan. Thanks for watching.